Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We have a little bit of a deep dive here in store for you. This is not usually the kind of thing that warrants a deep dive from a kind of near-term perspective, and we'll explain why in just a second. But it is an important educational opportunity that the markets present us with here to learn a bit about market structure and a bit about how everything works, so that when you go to trade these markets, and in particular currency markets, you know what you're looking at when things do things that maybe you were not expecting. So we're going to focus on Japan. We have Japanese CPI data that's coming out here over the coming 24 hours. And so we're going to take the opportunity to look at that data and really unpack how the yen works, because it's very much a different animal than a lot of the other major currencies. We've, of course, talked about the special dynamics that the US dollar has. We've talked about the dollar smile. We've talked about the notion, ludicrous though it is, that the dollar might be replaced as a global reserve currency. In case my position on that were not clear, I think that's utter nonsense, and the math simply doesn't work. But most other currencies have a kind of way that they work. The yen is another one of these exceptions, which works a little bit differently than really anything else. So let's unpack why and how. The first thing that, of course, we want to do here, just to make sure that we're being thorough, is look at what the actual data looks like. And there's a lot going on in this chart. So let's go through here and see exactly what's occurring. The red line is Japanese CPI, and it is expected to come in from 3.3 to 3.2% year on year. So you can see here we've had the kind of large run-up in CPI that we've seen in a lot of other corners of the market, and indeed almost everywhere. So no big shock there. It's the makeup of this inflation that's important. So I want to direct your attention to the labeling of these bars and lines right under the title there, where you see wages in the yellow bars, you see CPI in the red line, and both of them are marked with an 8-month lag. So this is data that's been pulled into the past by 8 months. The dark grayish bluish line that you see there is the Bloomberg commodity index. That's just an index of raw materials prices across varieties. So it's an index that includes precious metals and industrial metals and soft commodities and hard commodities and energy and grains and all kinds of things. So it's just a broad sort of sense for what do commodity inputs cost. You'll notice that is not lag. So effectively what I've done here is I've pulled wages and inflation into the past to show you that the commodity structure, the price trend in commodities, leads CPI and wages by 8 months. In other words, it's the commodity prices that echo back into CPI and into wages as people basically demand higher wages to deal with higher costs than anything domestically driven. So it looks as though Japan's inflation is essentially imported. It isn't so much that there is an upsurge of inflation in Japan for reasons of Japan's making per se. Rather, it seems that there is a jump in global commodity prices, and 8 months later, it shows up as inflation in Japan. Because, of course, Japan is an island. It imports a ton of its commodities that it uses, be it soft or hard commodities. And so, from the looks of things, this is not the kind of thing that's amenable to domestic policy per se, because on the one hand, it doesn't come from domestic sources, and so doesn't really seem like the Bank of Japan really has the sort of inflation it's been trying to get. Bank of Japan, of course, famously struggling to get inflation to 2%. It's north of that now, but it doesn't seem to be the kind of inflation that the Bank of Japan can bank on staying. Because as you can see here, what the commodity index is doing is, at this point, trending lower. It seems to have peaked, which would be consistent then if the inflation is primarily imported with a pullback. Now, wages can be a bit stickier, of course. We've heard the Fed bemoan this too, that we might have a temporary sort of transitory conditions-driven rise in inflation, but to the extent that it bleeds into wages, it might become entrenched inflation because wages don't readily adjust back down. But at this point, it seems to be that Japan's inflation story is one that's externally motivated, and so its current setting doesn't particularly seem to warrant any kind of action from the Bank of Japan one way or another. And if the data doesn't imply action from the central bank, it doesn't necessarily command interest from the markets. Because what the markets care about isn't so much the data, but what's going to happen because of it. What's going to happen in the risk-reward balance, in the yield balance, in the return balance for the relevant assets as a consequence of the data. And if the central bank isn't going to do anything in particular because it comes from somewhere that isn't a domestic catalyst, and the place it's coming from already shows that inflation might be on the wane, well, then there isn't really much to do. If we look at the relationship, this is now all in real time, nothing is lagged here. If we look at the relationship between Japanese inflation expectations, that's the 5-year break-even rate there. That's a difference, as we've said before, this is one of our favorite market indicators of inflation expectations. This is the difference between nominal and real or inflation-adjusted bond yields. So when you take that difference in those yields, you get the magnitude of the inflation adjustment that takes you from nominal to real. So you can get a sense of what the bond market thinks inflation is going to be, in this case, 5 years forward. And you can see that as commodity prices start to come down, that 5-year break-even basically flatlines. Now, this, of course, sets up a much larger conversation. If the Bank of Japan isn't going to move on this, it has an inflation target of 2%. It's currently looking at inflation more than a full percentage point higher. If this isn't going to motivate them, what is? And what's then going to motivate the yen? What is it that actually makes this currency move? If it's not domestic economic data, especially inflation data. Well, let's take a look back in time. What you're looking at here is basically the entire modern history of Japanese monetary policy, basically from the start of floating exchange rates in the modern era. So the gold standard variously collapses and is shelved in the early half of the 1970s. Famously, Richard Nixon takes the U.S. off the gold standard right around there. And of course, the Bretton Woods system in place before then basically pegged everything to the dollar and the dollar to gold. So once the dollar got unanchored from gold, everything got unanchored from gold as a consequence. So what you see here is really striking. Since 1973, Japan's oldest sort of overnight rate, the BOJ discount rate, it's basically, if memory serves, a value that goes all the way back to the 1880s. So this is about the oldest way to look at Japanese interest rates and monetary policy. From the 1970s onward, you can see there is a very consistent decline in both inflation, that's the red line, and of course then rates. The lower the inflation, the lower the rates, understandably so. And you can see that basically going all the way back to the mid-90s, inflation is idling, and the base rate, that discount rate, is essentially pinned within a hair of zero. Not only is it pinned within a hair of zero for a period of decades, but you can see in the yellow line there the attempt by the Bank of Japan to shake this loose. That's the Bank of Japan balance sheet as a percent of GDP, which you can see now is somewhere around 130%. Give or take. In other words, the Bank of Japan has injected about 1.5 the size of the entire economy in liquidity into this system to try to get inflation higher. And until this episode of imported inflation, the blip you see there around 2021 and thereafter, there hasn't really been anything to suggest that this massive amount of stimulus is having any kind of effect whatsoever. Now, why is it that the Bank of Japan wants inflation higher? Let's answer that question. Well, inflation is a kind of motivator for consumption. If you think something is going to be more expensive tomorrow than it is today, maybe you'll go and buy it. Deflation is the opposite. If you think something is going to be cheaper tomorrow than it is today, well, then you're not going to buy it. Unless it's something essential like food or shelter, you're going to wait as long as you possibly can. And this certainly doesn't speak to deflation per se, although there's certainly been periods of that in Japan. But inflation is basically stuck at very low levels. And so the kind of pull on consumption that you would expect to see just isn't occurring. And of course, we know that household consumption is the overwhelmingly dominant source of GDP growth for most economies, and certainly for developed economies like Japan. So what you have here is an inflation that isn't going anywhere, and as a consequence, economic growth that isn't really going anywhere for decades at a time. So the Bank of Japan is trying to motivate It's trying to shake things loose. That's how you get that surge in the balance sheet. That's just QE. It's not really doing it, though. And naturally, the question is why? Here's that same chart, but I've replaced the balance sheet with a year-on-year growth rate in Japan's working age population. So that's older than 15 and before retirement, which in Japan is about 65 years. So by 64 is the retirement age. If memory serves, at 65, people are retired, generally. And so what you're looking at here, through this entire period where inflation and rates really sink and get anchored, is a decline demographically. So Japan's working age population is shrinking. You can see that it basically stops growing around the early aughts. So in the wake of the 08-09 crisis, it basically stalls at zero and has actually started to dip negative. Why is this what's driving things here? Well, when people are younger, that's generally the phase of life in which they tend to consume. They tend to be building their nest egg, creating whatever life they want to build for themselves, either buying property or buying the things they want to own, having families and financing that. So there's a lot of spending there. As people get older, there's less. Not only that, but there's a more pronounced incentive to save, because the closer you get to retirement, the more saving you're ostensibly wanting to do. The less time you have left to reaccumulate savings if something goes wrong. So if you decided to go and roll the dice on some speculative investment and it didn't pan out for you, and you're 30, let's say, well, then there's plenty of time for you to be productive and rebuild your cushion. The older you get, the less time there is. And so there is a sort of inherent headwind to consumption as this working age population shrinks. And as we just said, consumption is what the Bank of Japan is trying to motivate here. It's trying to create demand. That demand ostensibly would put pressure on inflation and allow rates to start to climb. That's not occurring here just on demographic grounds. There's just not enough people wanting to buy things. And so when you look at the way things have been evolving in Japan, rates-wise, here's the latest yield curve. We look at it here relative to the last BOJ meeting. That's the big dash line there. And then from a week ago, the first thing you see, naturally, is that these are paltry readings. So we're thinking that maybe we'll get to 26 basis points on the main rate in 3 years' time, which of course stands in dramatically stark contrast to, say, the US, where rates are on approach to 5. The interesting thing here is you have a bit of a shift in the yield curve since early March, ostensibly because the yield structure globally took a bit of a knockback around the SVB signature Credit Suisse banking crisis shenanigans. But nothing has really shifted very much. Nothing is really going anywhere very quickly, and these values are very, very low. So you can see that, but for a little bit of a blip, situation in Japan is idling. You can see it in policy expectations through the end of this year. Note, in particular, the implied rate delta column. The biggest number there comes in December with maybe a 7 basis point move, 7 or 8 basis point move implied, which, by the way, is the equivalent of a 76% chance of a rate hike, because these rates have been moving in increments of 10 basis points rather than the 25 that's usual for most central banks. In other words, what you're seeing here is maybe we'll get from essentially a negative 9/10 of a basis point move in the rate now to maybe a 7 basis point positive rate by the end of the year. And even that's a bit uncertain here. There's the possibility that that won't actually occur. It's not fully baked in. So very, very low numbers here, clearly not the kind of thing that's going to motivate markets to buy yen because of rate hikes or to react to inflation data with expectations of tightening. And so naturally then the question becomes, so then what moves the yen? Clearly it moves up or down. Clearly it has some significant swings. If we look at the yen's various exchange rates, it can actually be moving quite significantly. And as a matter of fact, when we look at what's been happening this week and sort of consider that stocks have been idling, for the most part, the major currencies have been idling. One of the standouts has been the yen, which has been limping lower in a more convincing fashion than trend development elsewhere. And this seems to really capture it. So the blue line here is the 10-year yield average for the major kind of deep liquid bond markets, the US, the UK, Germany. I'm obviously leaving Japan aside for a reason. What we're looking to do is to isolate. And then in the red line, you have 6J futures. That's the Japanese yen, the sort of baseline contract there. And I mean, very clearly, you can see with the naked eye that there is a straightforward inverse relationship. So it appears to be that when yields go up globally, the yen tends to suffer. When yields go down, or at least idle, you can see that going into the turn of the calendar year here, there the yen seems to shine. Now, why is this? Well, this is that element of the yen having a kind of appearance of a haven asset. And I say appearance because there's nothing about the yen that makes it particularly safe. Like the dollar, it is liquid, very liquid. You don't create 130% balance sheet relative to GDP levels of liquidity and not have a ton of it. So it is very liquid. In that sense, it has certain anti-risk qualities. But there's nothing particularly safe about it per se. What there is, as we see right here, is a very long history of very low interest rates. And so if you are a Japanese investor, if you are trying to build a nest egg, it becomes very difficult to do domestically because there's just no rate of return to be had. And so what you tend to see, this is when people talk about the quote unquote carry trade, this is what they're talking about. You have this tendency in Japan to borrow in yen because it essentially costs nothing, and then to buy assets abroad, which yield more than nothing. So you have a sort of inverse relationship with the yen and yields, because when yields abroad go higher and thereby make owning assets denominated in currencies other than the yen more attractive, and Japanese savers go, well, we can't save at home, so we have to go save abroad. There is a sort of migration of capital out of yen into other currencies so that these yields can be had. Now, of course, bond prices and bond yields move inversely. So what this means is that the yen moves generally with bonds. And of course, we know that when there is risk aversion, bonds tend to rise because capital leaves the relative risk-on asset universe, stocks, etc., and heads for the safety of cash and bonds, which are both liquid and relatively less volatile. So, for the most part, of course, we're painting with a broad brush here, generally. So what we're seeing then is this appearance of maybe a would-be haven, or at least something that behaves anti-risk, where if stocks go up, the yen oftentimes is heading lower, and vice versa. But of course, the issue is that of yield. When stocks go up, yields tend to go up. Needless to say, this has not been the experience over the past year, where the risk aversion has come from rates. It's come from central banks tightening in the face of inflation, and that has encouraged bonds, or stocks rather, lower, not higher. And so this kind of relationship between stocks and the yen has weakened. But the relationship between bonds and the yen, as you can see here, is very much still there. So there is, and it's still there because of these internal dynamics and really demographically inspired dynamics inside Japan. And so in trading the yen, what you're really looking at is more so a trade on the bond market, on yields, rather than just about anything else. And so the yen belongs more so with the ZTs and ZNs and ZBs of the futures world. So futures tracking U.S. debt instruments, belongs with gold, to some extent belongs with silver, which are animals primarily driven by yields and relative return on paper money, rather than the kind of dynamics you would traditionally see for other currencies. It trades more like bonds and precious metals than it trades like the euro or the pound, because of these idiosyncratic factors specific to it. And so the next time you're looking to take a bet on the dollar relative to the yen, or you're looking to take a bet on a different currency relative to the yen, this is an important consideration. This is not the kind of thing that you would expect to behave as other currencies do. With that, we have today's Macro Money. Thank you very much for joining us. Hopefully that was educational. We will come back tomorrow for the last show of the week, talking, I expect, about the upcoming PMI data and what it says about recession risk. So do tune in for that. Macro Money is here Monday through Thursday every week, right after overtime, with Chris Vecchio, head of Futures and Forex here at Tasty Live. I'm on with Chris again on Fridays for Futures Power Hour. I'm on Sundays with Tom and Tony for First Call. And outside of the shows, you can catch me opining on Twitter at Ilya Spivak. Thanks very much, everybody. Good luck out there. See you tomorrow.